So welcome to today's podcast. I'm Pat Soldano, President of Family Enterprise USA and Policy and Taxation Group. We're very happy to have you with us today. If you don't know who we are, we advocate for generationally owned family businesses and their lifetime of savings at a national level in Washington, D.C. We advocate for all sizes of business and all industries. All sizes meaning small, medium, and large, and all industries. My guests today are Caren Street, who is a principal of law and of government relations firm Squire, Patton, Boggs, and Mark Warren, shareholder and legal expert at the law and government relations firm of Brownstein. So Caren's a seasoned Washington, D.C. operative with 17 years of experience on Capitol Hill and in government relations. She's a principal of her firm's public policy practice group and advises clients on public policy and government relations strategies at the federal, state, and local level. So prior to joining Squire, Patton, Boggs, Caren had 14 years of bipartisan, bicameral, and leadership experience on the Hill. Welcome, Caren.
Thank you.
Mark has worked on every major tax policy debate since the Clinton administration. Legislators on the Hill know him well. He spent more than 2 decades serving as a congressional tax counsel spanning 4 administrations, including as chief tax counsel to Senate Finance Committee. He also contributed to the development and drafting of key parts of the Tax Cuts and Jobs Act, which we're going to talk a lot about today, as senior tax counsel to the Office of Senator John Thune. As we're all aware, the extension of the provisions in TCJA is the number one topic, and we're going to discuss that in great length today. So it's great to have both of you with us today. So let's just jump right in. It's been a few days since the president's come into office, and we are all anxious to hear what your impressions are about what's going to happen in the first 100 days. And I'd ask you to first keep this at a very high level, kind of an overview, because we're going to get into the more of the details as we get through this podcast. So with what do you think? What do you think in the first 100 days is going to happen? Mark, I'll start with you.
Well, thanks, Pat. I appreciate the opportunity to be here with you today. With the second Trump administration, it's we have a little bit of insight given the first round. I think they've come out of the gate a lot more organized this time, and I think you probably saw on Inauguration Day, it was a flurry of executive actions, orders and memos, really covering a whole variety of areas. I think he is indicating a number of policy areas that they want to work on. And in the backdrop is the effort to try to make sure that the Tax Cuts and Jobs Act provisions, largely on the individual side, a lot of those affecting, pass-through business owners, family business owners, that are going to expire at the end of this year, Congress doesn't take action. So they're in kind of the early stages, and I think what we're starting to see develop is the path forward for Congress to move legislation that will include those expiring provisions, and it probably is going to include quite a bit more, kind of given the dynamic of the way the House and the Senate are. This Congress with very, very thin margins. So I think we're gonna need to see, and we'll talk probably more later on about some of the details. But policies, spending cuts, fiscal responsibility measures to assuage some concerns of some members while trying to get these tax policies extended or made permanent if they can do it.
And I'll just say from the Democratic perspective, I think the Democrats in Congress are still trying to figure out what a winning message is, and obviously recovering from the heels of the last year's presidential election. Coming in early on, one of the first major bills that was put before Congress in the House and the Senate was an immigration bill that ultimately ended up getting bipartisan support. It is rare that you see the first bill that a party puts out to actually have bipartisan support. So I think that is emblematic of the fact that there are vulnerable Democrats who felt that they had to be supportive of that legislation because ultimately the messaging that they went into 2024 with was unsuccessful. So I think you'll see in these first 100 days, Democrats, particularly Democratic leader Hakeem Jeffries, trying to develop a strategy to balance social policies with economic policies in preparation for the midterms next year. And kind of in the vein of bipartisanship, in these first 100 days, we have to fund the government. That is going to be a major priority. Republicans had the opportunity to put forward a spending bill that would take us through the end of the fiscal year in September. They chose not to. They chose to go with the short-term CR that was first loaded up with a number of policy riders and then had to be whittled down. But ultimately, we've got until, I believe, March 14th to fund the government. And the appropriators are kind of working through the opening salvos of that negotiation process. But within margins, particularly in the House of Representatives, in order to fund the government, that will need to be a bipartisan effort. And it will be interesting to see how the bipartisanship of appropriations plays out with what is largely going to be a partisan effort, at least at first, on reconciliation and tax reform.
And
Well, to
Karen,
that point, Caren. Oh, go ahead, Mark.
Pat, I was just going to add to that the reconciliation or the tax legislation will probably continue to move on its own track, but Congress is going to have to take a break and deal with the funding of the government, as Caren mentioned, in March. And adding into that, we have had the just heartbreaking fire damage in Southern California, on top of the hurricane damage in here on the East Coast from last year, and the need for disaster relief funding, which is going to also add to that debate. And that whole debate is going to have to be in a bipartisan fashion because there isn't a way, particularly to get that through the Senate without the potential of a filibuster.
Well, let's talk about bipartisanship. Caren, what about a tax bill? What about when they do address the TCJA expiration provisions or provisions that are going to expire? Do you think they're going to need bipartisanship, and you think they're going to need Democrat votes, and are the Democrats going to help?
So I think it's hard to make predictions this early. What I would say is reconciliation, despite the fact, and Mark reminds me of this, there is precedent for bipartisanship and reconciliation packages. The beauty and allure of reconciliation is that it allows you to move legislation through a simple majority. And that is critical in the Senate, where you generally need 60 votes, which requires bipartisanship to move anything forward. With reconciliation, you can move with the simple majority, and with both chambers controlled by one party, you don't need the minority. The scope and cost of TCJA provisions, as well as the cost of some of President Trump's campaign promises around tax reform, will probably push Democrats away from being supportive early on, because the vast majority of those provisions might not be bipartisan. And in that regard, I think that Democrats will try to keep their powder dry. We could see some bipartisanship if this is a long, drawn-out process. There are maybe failed efforts simply on a Republican Party vote line that create some opportunities for Democrats to put in their own priorities around tax reform. It could turn bipartisan, but it's too early to say. And at this point, I would say it's pretty partisan.
And I'll add on that there was a letter with 11 Senate Democrats that recently indicating that they would like to work with Republicans on tax reform. It was very, very general. And I think that was an opening indication that there's at least an interest I'm not sure that the leadership on the Republican side is going to embrace that on the front end. I think they're going to try to use reconciliation, and they may be able to succeed. It's going to be incredibly difficult given how thin the margins are. But I agree with Caren that, in the end, if they aren't successful later in the year, no member wants to go home, Democrat or Republican, go home in January of next year and have to explain why there's a massive tax increase on everybody, because all of the tax rates and brackets are going to expire at the end of this year. So it's it's making for some type of tax bill to have to get done at the end of the year, and that means they can't get it done on a Republican only to the full extent of a straight extension. Then there may have to be a compromise.
So you talked about reconciliation quite a few times. So one or both of you explain the process where we are right now with the budget resolution process and the committees, and how does this bill advance?
That's a good point. We are too used to using the term without explaining really what it means. But budget reconciliation is a streamlined process that basically only matters to the Senate because it overrides the 60-vote filibuster general rule that applies in the Senate. But to use it, it comes with a whole bunch of restrictions. So it's a several-step process. The first process is that both the House and the Senate have to adopt a budget resolution, and that budget resolution has to identify, it has to basically tell committees for the Tax Cuts and Jobs Act, it'll really be the Finance Committee in the Senate and the House Ways and Means Committee, and tell them that they are to report a bill, and that bill either has to raise revenue or it can increase the deficit, and it can also, the reconciliation can also include spending, so other committees can be involved, but it gives them a very broad parameters with a dollar figure and a date that they are to return that bill to the Budget Committee. And then once the budget is agreed to by both the House and the Senate, the president doesn't have to sign it. It's only a congressional document. Then the committees have their instructions, and each committee goes and crafts their bill to meet whatever their dollar figure is. So in this case, the Finance and Ways and Means Committee will have to figure out, and we don't know what the number is going to be, but the estimates at the end of last year to permanently extend the expiring individual provisions were about $4.6 trillion on net. So theoretically, if the Budget Committee thought that there was sufficient votes, they could say that the tax writing committees could increase the deficit by $4.6 trillion, and they would produce a bill that took away the expiration dates on all of those provisions and moved forward. Now there are a whole bunch of also restrictions on what you can and cannot do in a reconciliation bill that will constrain, for instance, they probably can't make permanent all of those expiring provisions, but they could do it for 10 years. They can't do anything on Social Security. So the president's proposal on the campaign trail to do away with the taxation of Social Security benefits cannot be done in a reconciliation bill. So once those bills are done, Budget Committee puts them together, and then both House and Senate have to pass the same bill. So there can be some back and forth amending, but it's a complex and drawn out process that is not going to get completed in the first 100 days.
I think another point to layer on is as eloquently as Mark elucidated the complexity of the reconciliation process, you have to consider the challenges of the political realities here too. You have the House and the Senate, and even some factions within the House debating whether or not we should have one big, beautiful bill. So one reconciliation package that includes, a lot of the Republican priorities around energy reforms, border security, possibly some issues around healthcare, as well as tax reform, versus a two-step strategy, which allows Republicans to kind of get some points on the board early on around some of those high-profile issues, and then kind of saving tax reform for a second reconciliation package. And as Mark mentioned, they have to have a consistency and in those instructions, and you can't have the House moving with two steps and the Senate moving with one. So they have to come together, both in the House and the Senate. And in terms of added complexity, TCJA was largely driven by Congress in its first iteration. You're now dealing with Trump 2.0. Who's much more involved, much more engaged in this process. As Mark mentioned, he's got these campaign promises that he wants to see some movement on. And unlike 2017, he's going to be much more involved, and that's going to add more challenges for congressional leaders who have to find a way to make those promises a reality.
And challenges in an environment in the House where, right, if about now they have a voting margin of 1. So it's basically going to require that this package have unanimous consent among the Republicans. So that's also going to mean that the president's going to have to be very much involved. If any squeaky wheel, he's going to have to go and address that concern or persuade that member to join the majority.
So let's get into the specifics of TCJA and what you think is possible. And we're not going to address every one of these provisions, but we're going to address some of the provisions that are very important to our family business owners. You all know this, you hear me talk about it a lot. The number one issue for family businesses and successful individuals today in America is the rate of the income tax for individuals, because we've learned that 80% of family businesses operate as a pass-through entity. So they're paying a higher rate of tax than corporate America. And along with that is the provision around 199A. So what do you think the likelihood will be that the current rate of income tax will stay where it is, get extended past the expiration at the end of 2025, and maybe you could couple that with what's the likelihood of retaining 199A, which is the 20% deduction for those pass-through entities?
Sure. Let me start, and Caren can correct me where I get it wrong. But the tax, all of the tax rates in our 7 brackets, all but the bottom 10% rate were lowered in TCJA. So all of those will snap back up to a higher rate. The top rate currently is 37% this year. It'll go back up to the old 39.6. In addition, all of the brackets were expanded. So more income was taxed at lower rates. So both of those will expire. And that will mean basically every working American at every level will see a tax increase if nothing happens. As I mentioned, politically, no member wants to go home and have to explain that. So I think there is a very strong likelihood that those will be extended. I think at all levels, and I think going back to 2017, the reason that the top rate was lowered from 39.6 to 37 was a number of the senators in particular were very concerned about pass-through business owners, the family business owners who are almost all of them, and they're not necessarily very high income, but because they're paying tax on their share of the business earnings, whether they take it out of the business or not, a big portion of that often is in the top bracket. So the idea was, let's bring that rate down to make sure that pass-through business owners, are seeing a rate reduction, especially for those at all levels, but not excluding those that are having to pay in the top bracket because they're taxed on all the earnings. So I think there's a very strong likelihood that they will be extended. I think the question for how long remains open. That gets us much more into the whole debate about the members who are very concerned about the fiscal situation and whether they can find spending cuts or tax increases or are willing to use deficit financing in order to extend them. Is that the longer you extend them, the more revenue does not come in if you're lowering rates. And then lastly, I'll just mention on the 199A 20% pass-through deduction. I think that also is very likely to be extended. In fact, yesterday, Senator Daines introduced the straight extension. Actually, it's a permanence bill. It was introduced for 35 senators, and I heard this morning from his office that they're up to 39. And then Mr. Smucker from Pennsylvania introduced the companion bill in the House. The system hasn't caught up, so I haven't been able to tell how many co-sponsors they have, but I think it'll be, equally broadly supported. So I think those are very strong candidates, and will be extended as long as the members can, given the broader fiscal situation.
And I would just add, I totally agree on the individual rates. And I think especially if this delves into a bipartisan effort, because Republicans are unable to move tax reform on reconciliation on their own, certainly Democrats have the same concerns around individual tax rates increasing, particularly as they're trying to maintain an economic message that hits home to middle-class families, but quite frankly, families up and down the economic spectrum, while you have inflationary concerns and the cost of groceries so high, and et cetera. I think there isn't a single member of Congress that I think would be comfortable with rates increasing at this time. And with regards to 199A, I think it's an opportunity to recognize you, Pat, and the work that you've been doing for years to try to educate members of Congress about the realities of family-owned businesses, the fact that 80% of them are actually set up as pass-through corporations or pass-through entities as opposed to C corps. Something that we've heard from a number of members, including Republican leadership, is candidly there is an education need here around tax reform. A lot of members that are on the tax writing committee, particularly in the House, were not there in 2017. A lot of members were not in the House in 2017. So there's certainly more work to be done around educating those members, and that's where it's important to have organizations like FEUSA and PATG there to help educate and advocate for 199A and family businesses in particular.
Well, thank you for that. We absolutely agree. A lot of education is necessary, and the Congressional Family Business Caucus helps us with that as well, participating members of Congress as well as us trying to get our message out. So let me move to another issue that's very important to family businesses and successful individuals as well. It's second on their list, and that is the estate tax. Now, we were pleased to see this week that a estate tax rate reduction bill was introduced in the House with bipartisan sponsors, reduces the rate from 40% to 20%. Let's hope that gets some legs. But meanwhile, there is the exemption amount that's in TCJA of $14 million plus per person, double per couple, that's going to expire at the end of 2025. It's a very high exemption amount. It's been very helpful for families to use and plan. What is the likelihood that exemption amount is going to stay where it is through the 10-year window?
I think there's a good chance that it at least is extended as long as the rates probably are. I think, again, it goes to sort of the fiscal side of this package. The amount was the exemption amount was doubled in 2017 and then inflation adjusted. So this year, as you said, it's $13.99 million per person, so almost 14. If it expires, it'll go back down to around 7 next year. But also because we've got now the so-called portability between one spouse and another, so that if I pass away and I don't use my almost $14 million, my wife can use that with hers and that will help protect. If we had a family-owned business, it would help protect that under the estate tax. So, I think it will be. It's high on the list. Very important for members. I think in particular, with the agricultural members, which are very heavy Republican agricultural members on the Finance Committee. I think there's a recognition, like with family-owned agricultural businesses, that if the estate tax were to hit, that it can mean having to sell off land. Same thing for more manufacturing and other types of family-owned businesses, where actually it's harder if you have to sell off pieces in order to pay that tax. So I think that realization has registered with a lot of members, and they understand that. I think there is a very strong interest in going further on the estate tax, but the fiscal cost is just so much more expensive. So I certainly applaud Mr. Arrington from Texas, who introduced the bill with Representative Sanford Bishop from Georgia, Democrat, in the House, which Pat, your organizations have been instrumental in helping to develop, that would reduce the rate, at least, so that if we do have to have an estate tax, the ideal would be to maintain the exemption amount, but for a lot of family-owned businesses, the valuation is well over, $14 million. So, we need to make sure that the rate is lower, and kind of, I think, arguably, why should you have to pay more on the disposition of a business at death if you have to sell it than you would during life? That's where sort of the capital gains rate concept, I think, makes a lot of sense. But again, I think most Republican members would prefer to do away with the estate tax entirely. It's just, from a fiscal point of view, probably not realistic right now.
I would just add that I think I would underscore Mark's point around the impact of the estate tax on particular industries where members are concerned about consolidation and offshoring. So of course, agriculture and manufacturing in particular.
Someone has one more question around specific proposals, because they're important to our family businesses and our successful individuals, and that revolves around the expiration of R&D expensing, which we know has already happened. So now it's required to be capitalized over a period of time, and added to that is bonus depreciation that's also gone away. Both of those provisions are very, very important. Maybe you could comment on the likelihood that will be, either of those provisions will be included, or both will be included in any tax bill that's put out by Congress.
Yeah, I'll start again.
Sure.
And I'll add a third, actually, but it's of lesser. I think that the most important of those three, in politically and I think practically to the economy, has been the R&D, the expensing of R&D expenses. That switched over to a 5-year capitalization and amortization requirement starting in 2022. I think the impact that has had on investment in research and development in this country has been noticed and felt by a lot of industries, and I think members of Congress have understood that that's not ideal in a world where we struggle as a country to maintain our competitiveness with other countries on R&D. So I think that one definitely will be back on the table. I think also, given the challenges of the way that amortization works, I think there's also a real motivation to try to make that go back to expensing and make it permanent, or at least make expensing last as long as possible, so that we get the most economic benefit out of more research and development activity here. Bonus depreciation is a concept of instead of stretching out the cost recovery of a machine over 7 or 15 years, that you'd be able to recover all of that cost up front, which then allows the capital cost to be redeployed in the business and leveraged. That provision from the Tax Cuts and Jobs Act, that was 100%. Starting in 2023, it started stepping down in 20% increments. So this year it's 40%, next year it'll be 20%, and then after 2026 it goes away. I think there's a lot of interest in trying to restore that, ideally back up to 100%. It could be at a lesser amount, again, given the fiscal pressures. And at the same time, whatever level, it's a question about how long would that be extended. And the third one I'll add is there's a limitation on the deductibility of interest for many businesses, that the deductibility of that interest is important because for a lot of businesses, they have to borrow in order to buy the equipment that bonus depreciation is intended to incentivize. So if you can incentivize all you want, but if you make the cost of that capital too high, then they compete against each other. So I think those two will work together. They can be extended for a shorter period of time if they had to from a fiscal point of view. But all three of those business provisions, I think, are definitely back on the table, and there's a real interest in trying to extend or make them permanent.
And Mark, correct me if I'm wrong, but I believe all three of those provisions have had significant bipartisan support in the past.
Yes, certainly R&D probably the most.
The most.
Yeah, I think there's been support on bonus depreciation, but there's also been a view on the Democratic side that it shouldn't be at 100% because it's a tool for economic stimulus in a downturn.
Mm-hmm.
And I think that the interest limitation is, because of its complexity, it's just not as well known or understood. But like I said, it is interconnected with bonus depreciation and really important.
So I'm going to ask this last question because I think it's so important to family business owners and successful individuals. And then we can wrap up the podcast. So the tax code in this country is complicated, but more importantly, it's always changing, and it seems like it changes more and more frequently. And one of the things that family business owners need is certainty and permanency, and they've been saying that for a very long time. It seems like we're not going in that direction. It's very hard to plan a business that you want to keep for 100 years when the tax law keeps changing in this country. Is there any hope that maybe this time around we'll have at least more certainty and permanency in terms of what our tax laws are going to be so that family businesses can plan better?
I'd like to say there's always hope. I think in this political environment, especially with the fiscal challenges, the solution here is probably going to be on the shorter-lived temporary side, just to be totally honest. The need for certainty and the long-term pressures for businesses is not lost on members. I think it's something that, as anybody listening to this as a family business owner, if you're talking to your representatives, help them to understand how that plays into your business. I think a lot of members who do not come from a business background, in Congress, they're looking at the current work period. They're looking at the current year, maybe this only 2-year Congress. And so helping them to understand that businesses, successful businesses, plan on a 5 or even 10-year plan. But I think in this situation, especially where we're looking at trillions of dollars of revenue cost to extend these provisions, the process is going to end up making this probably shorter term. And even where you can make things most of the business changes in the Tax Cuts and Jobs Act, other than with Section 199A, are permanent. But they're only permanent as long as a future Congress doesn't change them. So that's where I think educating Congress that if you're going to make changes, you should be very thoughtful on them and then leave them in place as long as possible.
Yeah, I completely agree with Mark's assessment. Unfortunately, given the fiscal constraints and the increasing concern around the debt and deficit, it makes it that much harder to make these provisions permanent. And as Mark said, even if there were permanent provisions, if in the future a different Congress, a different administration is concerned about addressing the debt and deficit, they may see raising taxes as a means of addressing that issue. But I also think that it makes it that much more important for family businesses to be engaged with organizations like FEUSA and PATG so that they can see what's coming down the pike and have an opportunity to hear firsthand and understand how to try to prepare best for the realities coming out of Washington, but also to serve as that resource to members and their staff who need to understand the implications of the votes that they're taking in Congress.
And I'll echo what Caren just said there, and just applaud PATG and FEUSA for their long-standing, very successful efforts. And I think that has been resonating and is an incredibly valuable tool for members of Congress to understand the impact. And that voice, is available and will continue as long as we're working with you. So I think it will be very effective and important in this debate.
But it's only as effective as your members are willing to engage, and the more members who engage, the more effective the organizations are. It's one thing to hear from advocates; it's another to hear from the constituent.
Right, and doesn't have to be here in Washington either. I think you'll agree, Caren. It can be at home. Members go home all the time to their district offices on weekends and during district work periods. So take advantage of that. If you have an opportunity to talk to your local representative or your senator, it's incredibly important that they understand, not only how valuable, your business is and your employees are as constituents, but, really what this current situation looks like for you and how important, again, kind of the long-term certainty in this case in particular, what that really means.
Absolutely.
Well, thank you both for saying that, because that's exactly what I was going to say. So really appreciate your kind words. And I would echo those remarks. Family businesses need to be heard. As they both just said, you can come to D.C., you can meet with your members in D.C., you can also do that locally. If you are a family business and you're interested in voicing your history of your business and what your concerns are around tax policy, or any other policy, we have a Congressional Family Business Caucus that FEUSA supports. March 11th of this year, May 14th, and September 17th. So if you are a family business, go on our website, reach out to us, and ask also your member of Congress to join the Congressional Family Business Caucus, which again, you can do from our website. So I really appreciate both of you joining today. I think it was excellent and incredibly valuable information for our family businesses trying to deal with what's happening in 2025. So again, I want to thank my guests, Caren Street and Mark Warren, for their insights and as to what we can expect in these first 100 days. We hoped you liked today's show, and if you did, please subscribe to our podcast, where each episode discusses the critical issues affecting generationally owned family businesses and their lifetime of savings and successful individuals around the country. You can find this podcast wherever you download your podcasts. Until next time, thank you for listening and watching. Take care.